Great. Okay. Thanks for being here. Today we're going to cover some risk topics. I decided to break the risk discussion into two parts just to keep these nice and short. And the first part's going to be on long risk, and we'll walk through a bunch of examples. And then probably next Tuesday, maybe the following week, I'll dive into the short risk, which is a little more complicated, but we'll have good context from this session. So with that, I'm just going to go into some of the disclaimers. Amanda, our head of support, is on vacation, so it's just me today. It's a well-earned vacation on her part, so I hope she's having a great time. Okay. First, the disclaimers. This is not a solicitation to buy or sell any security ever. This is not advice. You should read the characteristics and risks of standardized options. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risks of such investment in light of your financial condition. Great. I'm Jason Hitchings. I'm the CTO at Capital Market Labs, and I've been doing fintech option stuff for a long time. Okay, so we're going to cover long strategy risk today. We're going to look at an example of puts and then calls. We're actually going to dive into a support question that we got. That was a very good example to draw from. Kind of gives a good way to look at it through, the perspective of someone using the tool, trying to make sense of the amount of risk that they're seeing. And then I'll show a little sneak peek of something that's going to be coming out in the next week or two, the liquidity filter on the Today tab. Okay, so let's dive in. I am going to start with a little thought experiment, which I like to do. And this is kind of a matter of perspective. I don't think either one is right or wrong, but it'll give you a grasp of how TradeMachine handles risk and thinks about risk. So the scenario is, if you are playing a game of poker at like a friend's house and everyone buys in for $100, and throughout the course of the night, you're doing well, and you get up to the place where you have $800. You have most of what was there on the table. Someone comes back strong, and you end up leaving the night with $200. Question is, did you risk the initial 100 you came with, or did you risk the full 800 that you had at the peak? From one perspective, you doubled your money because you started with 100 and you ended up with 200. The other perspective is that you had at one point 800, and so you risked a total of $800, and you'd probably still view it as a profit because you left with more than you came from, but you could view your risk as 800, the sort of max that you had at any point during the night. So just, you can answer in your heads. So I'm just reading a little comment here. What you think, how you think TradeMachine handles this. Do you think that TradeMachine considers that you risked $100 or that you risked $800? So from TradeMachine's perspective, it says that you're executing a strategy. The strategy is going to last the length of your back test, and that the $100 you brought was the amount you risked, and that you're kind of playing with house chips, so to speak, or you're reinvesting your proceeds. It doesn't consider reinvesting your winnings as a risk within the context of a single backtest. If you backtest a portfolio, it'll add each ticker up as to the total amount risked. But each individual backtest with one ticker, it's going to look at that initial investment as the amount risked. So, next version of this, same scenario, you bring $100. This slide, yeah, so you bring $100 and then you at one point have to buy back, and so now you played with $100, you made some, you lost some, and then you ended up blowing out. But these rules let you buy back in, so you buy back in for another $100, and then the same thing happens. You go up to 800, but you end up leaving the night with $200. This would actually be flat in this case. It actually says 50% return, so that should be updated in that scenario. Because you invest at 200 and you end up leaving with 200, then your returns would be flat, according to how TradeMachine views, the kind of risk. Okay. So within TradeMachine, the basic way that risk is calculated for a long position is that you have a cost of a trade plus the commissions of the trade. And then you subtract from that risk any previous cash that you have. This would include if you had negative cash or positive cash. So in the very first scenario, if you start making new trades, but none of the trades are larger than the amount of winnings that you have, it's not going to consider that as new risk. On the other hand, if you keep losing and losing and reinvesting, then it'll look at that. So let's dive into an actual concrete example. I'm going to start with some puts here, and I want to start by looking at a trade with a single back test here. Sorry, I decided to move these slides around a little bit. So when looking at these two trades, the first trade here, in terms of the amount risk, I'm just going to pull this up real quick. So this is two different trades in NVIDIA, but I'm gonna zoom in here and just look at a single trade. So this started 1st of November 2023, and it ended, by the end of November. So I'm gonna put in, so that's okay. There's no trades here, but I'm gonna end it here in like December 2023. Okay. And so now we just have this one trade. And so if we pull up this trade, and you see that the amount risked here is 2138. And then you look at these trades here, well, the price of that contract was $21.38, and you did it 100 times. And so your cash outlay here was $2,138. I set the commissions you can put in this little settings box. I set the commissions to 0 here. If we made it $1 contract, you'd see it go up slightly. You go from 238 to 2138 to 2139. But that's the simple scenario, is just, okay, I invested, it was a $21.38 contract. I just bought one, and that's my amount risk. So that's the real simple scenario. But let's look at what happens now when you go from two trades. So now we're kind of zooming out a little bit, and we have two trades. It's the same strategy. That's the initial trade, and now you have this other trade up here. And so how do we think that TradeMachine is going to calculate this risk? So those are the two entry prices. One way to look at this is to say, well, let's just add the two trades up together. And when you add those two trades, the number comes out to something like $5,500. Seems like a perfectly valid way to look at the amount risked. But because we kind of maintain this concept of a constant cash balance, TradeMachine does it a little bit differently than that. we can see that the risk is 49.75. So how are we arriving at that number? So basically the first trade lost $1,600. The next trade cost, it's $33.75 per contract. We did one contract, so it was a $3,375 outlay. But we are already in the hole $1,600 for our strategy. So essentially, we had to re-up 1,600, or we had to draw in that much more cash to kind of keep this strategy going. So this is looking at the sort of running cash position with the new amount risked for each trade, and it's looking at that as the max risk. If your strategy just goes straight up and never comes back down, then the max risk is just going to be that initial trade. But if you have some losses along the way and you end up with a net cash balance that is negative, that's going to be added to your risk because you're having to draw in that much cash in order to place a trade. Now, if it goes straight up from here, then that will be the amount risked. But anytime it kind of dips down, then you're going to see that amount risk increase. But it's not going to be simply the sum of all of the trades that you did. It's kind of looking like you start off with an initial amount of cash, you're reinvesting that, and if it goes well, then it just looks at that initial investment. If it goes poorly and you have to pull more cash in, then it does count that towards the risk. And it'll look at whatever the biggest trade was that took the most amount of cash total is how TradeMachine will look at risk for a long position. Yeah, so it's not looking at those individually. Okay, we're going to return to some examples like that later. Okay, so this was the support example that came in recently. So if we happen to have the gentleman who sent this ticket in, thank you for sending it in, and it provided good example. What he was saying is that he did a back test with no limit, and he showed the max risk as $478. But then he thought that looked good, made sense to him. But he put a 40% limit in the strategy, and now all of a sudden the risk was $668. And he was looking at these trades. If you add up the trades, it's $570 total. The third trade had a loss, and he just didn't know, where did he come up with this 668 number? Like, there's no way to add these things up to get that. So I'm going to walk through it in real detail, which will hopefully be helpful. Okay, so this was the strategy. You can see the 668 amount risked. So I'm going to keep that at the top here. And so now we're looking at the individual trades. And now it's, instead of times one contract, it's times 5 contracts. And so you can see here, we're risking a little bit more than, a little bit less than 500, like 475, et cetera, et cetera. Then this one closes. It had a positive P&L, so we're up $260. Then we open another trade. This contract's at $1.06 times 5, so that'd be like 530, et cetera. This goes through several trades, and he couldn't see how we came up with this number. So I clicked on this download. So when you click the details of one of these strategies, when you click download here, you can pull up a spreadsheet and get a printout of all the trades. And I have one here where I actually kind of did the math that we're going to be talking about today. But I'm going to walk through it here for a second. Okay, so I click download, and then I get this. This is the kind of starting place that you get in this Excel spreadsheet. You see the P&L. It doesn't show a P&L at first until you close the trade. So it opened this trade, 95 cents per contract times 5, et cetera. And you can see the ones here that are negative kind of going down through this list. At some point, our profits end up kind of outweighing everything. But I'm going to add column by column to kind of walk through what's happening here. So if you're not familiar with Excel, don't worry about it. But on the right-hand side, I'm adding up the cash that we have at this point in time. So each time in this row, I'm saying, as of this closing trade, our cash position from closed positions is we're up $260. Then we're up 570 after this next trade. Then we lose $465, but we're still up net 105, etc. And then by the end, the strategy ends up being very positive at 1775. Okay, so this gives you kind of your current cash position as you're going through time in terms of the amount that you have, not invested in a strategy per se, but the amount that you have from proceeds. Okay, so he had 50 cents as his per contract fee. And so this $2.50 does get added to your risk when you're creating a new position. So if this thing was, $475, now all of a sudden it's $477.50, in terms of what that position costs to put on. Once you actually close the position, that's already baked into the P&L. So the P&L does reflect both the opening and the closing commissions. And if it expires out of the money, it does not charge you a closing commission. So it's kind of tracking that in a pretty reasonable way. So now we added the column for commissions. And so this new column is kind of the amount that the new trade is costing you to put on. So it's just 5 times the trade price plus commissions. And you can see the little, very simple Excel formula. But you can kind of think about this as like what the new position is costing you. So this is kind of the new amount of risk that you're taking on if you didn't have a cash position. Total risk takes the new trade risk and it subtracts out the amount of cash that you had previously. So the new risk here is 475. The new risk is, 532, but then it's subtracting out the cash balance. And so if you're starting from scratch, if you started this trading on the 8th of April, your amount risk would be 772. But this strategy's already made $570. So it's saying that this risk here is actually, you're only risking $202 because the rest is coming out of the proceeds. You're playing with the house money. When we look at the amount risked, we look at the kind of max risk that you took at any given point during the strategy. And so you had $105 of proceeds. This trade cost $772. It just happened to be the same amount. These are different points in time, but they happen to be for $1.54. And so this trade is $667.50. And that's ties out with, and then just gets rounded to the nearest dollar. And we saw $668 as the amount risked initially. So it's kind of doing some cash accounting about if you had created the strategy and you're tracking all the proceeds separately, how did that strategy do on its own where you're reinvesting the proceeds? If you draw down a lot from that, in the course of making that, if you have some losses, then your amount risk will go up, quite a bit. Even if, you kind of end up in the same place from a profit perspective. So hopefully that all makes sense. And there was an example at the beginning about, thinking about how TradeMachine does it from kind of a real world perspective. So one more little thought experiment here. Those were slides from earlier. So in terms of why we do it this way, this is kind of the second and last kind of thought experiment I'll do on this. If you placed a trade for $1,000 and the trade doubled and you ended up with $2,000, and then you just kept doing trades, but they all netted out zero. So you put another $1,000 trade, it just balanced out exactly even after commissions. You placed another 1,000 trade and you just kept doing that trade however many times you did it. We'll just say 100 times here. One perspective is that you put at risk, or you did a total of $100,000 of investment, sort of sum of all the positions. And the other is that you just invested $1,000, you made $1,000, and then you kept reinvesting the money, but nothing ever happened as a result of it. So in one scenario, you could view it as being up 100%, or in the other scenario, you could say that you are only up 1%. And the way TradeMachine looks at this is that the strategy overall performed as a 100% winner. You double your money in it. Great. So that's going to pretty much kind of be the starting place for our risk discussion. I just want to make a quick note here. And that is that for stock, if you look at like the margin regulations called Reg T that govern a lot of investing, most places say that the maintenance margin on stock is 50%. I mean, that's pretty typical. We used to use this for stock, but it confused people because they might see that a stock went up 25%, but their strategy showed a 50% return. And it gets even more complicated when there's splits and that kind of stuff. And so it was causing quite a bit of confusion. And so for the purposes of stock, we just say that we basically use the same rule with stock. We just look at assuming that you're buying the entire thing with cash. We're not looking at that from like a margin perspective. Even though with short options, we are looking at it from like if you sell a put, we are looking at it from like a margin perspective. We're not saying that you have to, cover the entire amount from zero up to whatever the strike price is. But when it comes to stock, we just say that, okay, you're paying for stock out of pocket. There's no kind of margin concept with stock. And we do that for both covered calls and for just standard long stock, to kind of keep that nice and consistent. Okay, so that'll be the kind of starting place for this risk discussion. In the next session, or maybe the one following it, I'll do a deep dive on the short version of this, which gets a little bit more involved. If you have a short put, there's or even if you have a put spread, like how far apart those strikes are determines if it treats it as a naked short put or not. So that one will have a few more steps in it, but I think from a conceptual framework, I think we made it was a good start today in sort of understanding how that all works. We do have a new feature coming up, which I wanted to give a sneak peek of, and that is this liquidity feature. So we're going to have liquidity filters, by popular requests, popular demands on the Today tab, and then those will make it into the rest of the product. And I'll just show a version of that real quick. So yeah, in addition to, and some of you may have seen a sneak peek of this already, but for anyone very, very new who's coming here for the first time, welcome. And when you log into TradeMachine, this is the Today tab, and it's what you see. Each of these represents a different strategy. You can click the little question mark button and learn all about it. Anything that shows today is a trigger that executed today that's sort of active and ready to enter when the strategy started. If you click on the ticker, it pulls up the backtest result, and it shows that this one is actually, even though it triggered at one point in the day, this one's no longer active. And so you can do that with any given symbol to see if all of the technical conditions are still being met. And what we've had some people say is like, okay, well, they try to put on a strategy, and then when they actually look at the option markets, things are, have moved a lot, and they're no longer active. And so that's what that live feature has. I'm just clicking through here to find one that, stayed active throughout the course of the day. So this one still says it's triggered. And so this one is still active. And then for, annual users, you have this kind of cool little extra feature, which is where you can click and actually see the options, to put on the trade. This one's relatively simple. Just says you buy that, April 19, 24, or the 129 calls for April 19, 2024. But sometimes when people try to put on the trade, they say it's like, okay, well, the thing is so wide, I can't really trade it. And so one way around that was to say only look at the largest companies with the most market cap. That was a pretty good solution. But sometimes there are smaller companies that actually are very actively traded and have tight markets. And so This liquidity filter going from 1 to 5 will say that the markets are tighter and tighter and tighter. So as you filter these down, you're going to see fewer results, but then you can be pretty confident that when you look at these, that they're going to be nice and tradable. And if you want things that are ultra tight, I don't even know if there's any 5s that triggered today. Okay, yeah, there are, which makes sense for some of these names. Now you can be sure that these are highly liquid and they're going to it's going to be very tight. You're not going to spend a long time putting on the trade because they're probably in a very close range. The way we look at it is the width of the option. We look at a 25 delta option 30 days out, so things somewhat out of the money about 30 days out, and then how tight that is. Those prices are the bid ask spread relative to the price of the stock. So for a $50 stock, they have to be tighter than for a $500 stock, but that's how we sort of gauge the liquidity. And so, yeah, that should be out within the next week or two. And so I hope everyone finds that really helpful. Great. With that, happy to take any questions if we have any questions. You can just put them into chat if there's anything you want to ask. Okay. There's something saying he's an AI assistant helping Gary. Okay. Yes, Jim, there will be QA. Have at it. Joseph, what's the difference between an alert with and without AI? Good question. So let's look at the Today tab. So basically what this AI signal indicates is that this trade is using something that we developed with AI called it's skew and kurtosis. And what those two words mean is the skew is if the stock tends to jump up or jump down in its movement. And the kurtosis is how big the jumps are, essentially. But we did some AI, machine learning, and large language models in order to develop something that's pretty sophisticated. And we have found that to be, through our own testing, to be very, very effective. It's done very, very well at outperforming the market and finding edge. So edge is, you can always flip a coin and maybe you make money, maybe you don't. Essentially, the markets are trying to price things correctly whenever possible. We're trying to find patterns that the market hasn't found yet. Trends that through technicals and other things that that sort of basically when things are a little bit mispriced. If you can buy an option, it's more likely to give a positive return and not not simply just to break even or like lose a little bit on the bid ask spread. So the AI signals are a special kind of indicator that we've developed using AI, using skew and kurtosis in a very specific way, and those have done very well in terms of their performance, both historically and since we've started tracking them. And so those just put a little extra emphasis on that type of alert. Jan or Jan asks, with the recent volatility in the markets, inflation reports, I got really scared with my existing trades. Put broken wing, butterfly, spread the sell off, and the put 1/2 by 1/2 ratio have been, gotten hurt big time to the downside. Is there a general guidance when to dump these trades with a sensible loss or how to defend them? Yeah, so in general, things that work well over the long term in terms of the putting limits or stops and limits or when to exit a trade, what we've done is we've taken the trades and we've back tested them through a variety of market conditions, including very bad market conditions. And we've said historically, does this perform better if you exit it early or if you take your profits early, through a whole variety of scenarios? When you're in the middle of a trade, it's easy to feel like you're in a new, you bring your own kind of like thoughts and concerns and feelings and biases to trading. We're fans of talking about having a plan and executing on the plan. The market is going to try to kind of prey upon it, not exactly intentionally. It just very easy to get, forced out of trades or get greedy with trades, it's very hard to make good, clean, rational decisions when you're in the middle of a trade, especially if it's a trade that's, larger and you're feeling the impact on your overall trading position. In general, the time to exit or time to, take profits are built into the actual strategies themselves. So there will be a stop loss or a limit gain built into the actual strategy itself. Right down here. So on this particular strategy, it says take the gains if they're above 40%. It does not say to exit when you start taking a loss. And another possibility is that you would exit after a certain number of days. Or if it's a pre-earning strategy, you might exit right before earnings. Or if it's a post-earning strategy, you might exit 7 or 8 days or 10 days after earnings. But if you want to stick as true as possible to what TradeMachine says, then those would be the only times you exit. And I know if you came in fresh and you placed a couple trades and just like got, market did some things and you hit some, bad times in the market and the first trade or two is hurting you. Yeah, it's really easy to just try to just change the plan or do something different. And, it's ultimately, people are going to make their own decisions about it. If your interpretation of the market is that things are bad, you know, that's your instincts are your own and you'll have to make your own decisions. We're pretty big believers in having a plan and trying to stick to it. And I took some of these spread the sell-offs, trades, and I also did not do well on them. I did Snow and Nike. Got hurt on those so far. I have not sold out the positions personally. That's just my own approach. I've done very well for the year. And I think that's one thing too, is just to size trades appropriately so that, even if the trade goes poorly, you can kind of absorb it. You don't want one or two bad trades to you don't want to have a bunch of wins, and then put on a huge trade and then have it, move against you and wipe out all your, good trades. So you can kind of, one way to kind of manage risk is just to size trades appropriately. And it's, of course, you should make whatever your best decision is about if you want to exit it or not. In terms of how TradeMachine works, we've tried to test scenarios as much as possible to say, on average, it works best to exit early or not. Like the straddle, you just exit anytime you get a 20% gain. So that's built into the strategy a little bit. But beyond that, just got to use your own judgment. The default number 5 is 5 contracts. Yes, we can change it to say 1, but the next login it goes back to 5. Can we save our preferences in the future so we don't have to change it every login? Yeah, that's a good question. All of these settings, and this is actually a pretty important feature. All of these settings, they actually do get saved. So if you change this to 10 contracts, if I log out and then I log back in, that actually should still show 10. But there's something that's happening, which is really important to bring to everyone's attention. And, we're always looking for ways to make everything feel, more sensible. But when you load a strategy, so now we have this share link, it overwrites all of the settings because it's trying to replicate that trade exactly. So when you see, a certain wins and certain losses and a certain percent return and all of that. So every contract fee, if you're executing mid-market or halfway between market, the size of the contracts, the deltas being used, the deltas are essentially the strikes in terms of how far out of the money or in the money they are. All of that information gets overwritten essentially when you click share links. So I do think you make a good point that we do need to temporarily load the settings from the backtest, but I agree that probably shouldn't retain it for the next time that you log in. So I wanted to go in a little detail about that so everyone knows how it works. But you make a good point that, yeah, when you log in next time, it'd be nice to differentiate between the last time you loaded a backtest versus the last time you click the save button. in theory, if you basically, yeah, if we add a cancel button, then that that should improve that situation. So that's certainly something that we can get done. Will the liquidity filter just be on the Today tab to start? When will it be available through the rest of TradeMachine Pro? It's going to start on the Today tab, and then it will. We have backfilled it. So then the next step would be to put it on, back tests as well, or to be able to filter scans by it. Yeah, it's a little interesting to think about, back testing where you don't want to put on a trade if the markets are too wide. We kind of have to figure out exactly, if that would be sort of part of a back test, or if we would just warn you that, hey, for a stretch of time, the liquidity is bad. Because, for instance, if you hit us, let's say the liquidity got bad until 2023, one way we could bring it to your attention is just to say, you know, something along those lines, that like the market was illiquid up until such and such a time. So we have to decide if that's really something we want to have built into the back tester, or if it's more that we kind of put it in the scans and we just notify you within the results. But yes, it will eventually make it through to the rest of the products. Do you recommend any brokerage for more complicated trades? We don't specifically recommend any brokerage. A lot of brokerages have complex order books, so you can add multiple legs at once and execute them all at once. I use Thinkorswim. I think probably Thinkorswim or Tasty Trade are probably the two most popular, but Fear uses Schwab, so there's no particular one we recommend. I think it's just kind of whatever you used to. Most should have a complex order book. If your brokerage doesn't have a complex order book to enter multi-legged trades, then it might be worth looking around a little bit. Is the AI version more likely to be profitable? From our testing, from the historical, what we've seen historically and what we've seen tracking the market so far, the AI trades are some of the trades with the most edge overall. So, I think the basic answer to that question is from what we've seen, yes, so far. Paul asks, I've been sending support some examples of an in-the-money long strangle where the maximum possible risk of the position is only a small fraction of the risk that TM calculates. Also showed that the difference between the actual position risk and the TM calculated risk. Given we're talking about long position risk, have you been able to give my examples any consideration? Paul, if you will forward that question again and just say, you can say at Jason Hitchings, or just say, please bring to Jason Hitchings' attention. I'll give that a deep look, or someone on my team will, and then yeah, we'll either respond to you, or maybe we'll even just bring it up in the next support session so that we can, get into it in detail. Joseph asks, for bullish burst, the stock price to cross above the 10-day exponential moving average among other requirements. By that logic, for bearish burst, stock price should cross below the 10 EMA among other requirements. Wonder why this requirement, the 10-day exponential moving average, is not specified in TradeMachine default setup. Okay, so I'm going to kind of answer that generally. So when you click the technical open, you can customize the technical opens. You see this skew and kurtosis. That's some of the signals that we developed with AI. So you can say that the stock has to be above or below, or cross up through or cross down through either the simple moving average or the exponential moving average over various time frames. So you can kind of customize that. In general, when we are looking at a 10-day exponential moving average, like the stock crossing up through it, is to say that the stock has some recent momentum, or especially if like the 10-day EMA is going to cross up through the 50-day EMA, that kind of gives you a sense of what the recent direction is on the stock. The bullish burst and the bearish burst are not identically opposite. The one is representing when the stock, through our back testing, is kind of set up to have a bullish burst, and the bearish bursts are the opposite, but the technicals are different for each strategy. So even though the names are similar, I mean they are opposite positions, looking at sort of like opposite times in the market, but they aren't they aren't like identically opposite strategies, in and of themselves. Yeah, are we still planning on playing Grassless Kurtosis? Yeah, we can do that. Yeah, the calculation, yeah, there's no reason that we can't do that. I know that, for most of the technicals, they are things that, that there's a way to view it that way. So yeah, we'll look at getting that into the product at some point. So I think this was the yeah, CNP here. So that was the bearish burst. Yeah. So then this particular technical setup is that the stock right now is less than the 200-day moving average, but yesterday it was above the 200-day moving average, and that means it just crossed down below through it. That the stock is also less than the 50-day moving average, and that the RSI, and that it's not oversold, that the RSI is greater than 30. So this is, the stock crossed down to the 200-day moving average. So the stock is below the average data point in the last 200 days. The stock is also below the average data point. I mean, that's you're catching it right when it crosses down through 200 days. The stock is also down below the last 50 days, and using, the RSI, that it's not super oversold. It's not like just straight down all of a sudden where it feels like maybe the downward motion's already happened. You can absolutely test just an inverted version of the bullish burst. You can just go into the technical setup and just, instead of greater than, you can say crosses down through, you can say crosses up through. You can just reverse every single trigger and see if it has good performance. What I can say is that we test a lot of things before we come up with those strategies, and for something with like a bearish burst, this is the combination of things that we found to be most effective. But that's looking at when we say most effective, we're looking over a long time range, 10 years. We're looking over bearish markets, bullish markets, that kind of thing. Right now, this is kind of a different signal because, if the market's been ripping and you're looking for a short term, like it just hit a top and it's going to kind of like, burn off some of the steam. Then yeah, I think this strategy, that's where the stock is like below the 200-day moving average or just crossed down below it, you know, for a lot of companies, that's not going to be the exact moment we're in right now. You could consider looking at like the VIX if you're looking for something in terms of, changes in volatility, changes in sort of market sentiment. The VIX is pretty good at capturing that. As the VIX increases, it's kind of the fear level in the market. So that's a way you could try to create a strategy similar to that. Okay, we're coming up in about 45 minutes, but I'll try to take one or two more questions. I am enjoying TM so far, keeping to beginner trades and trying to learn as I go. Lots of moving parts. Had some successful trades so far. Thank you. Great, Bill. Glad to hear it. Yeah, it's a pretty powerful tool, and our experience is that if you place a large number of trades using TradeMachine spread out over a large period of time, it's going to do pretty well for you. It's, some people get bad luck and their first trade or two is bad and they get discouraged. Placing small trades and starting with the ones you understand and building it from there, I think is an awesome way to go. And I think you're on a path to success. Kurt says, in some of the backtest 14-day pre-earnings I have seen where the 40 delta may be 4 wins and 1 loss, and the 30 delta may be, say, 3 wins and 2 losses, and the 20 delta may say 4 wins and 1 loss. How can a 20 delta be anything other than the same as the 30 delta? Looking at the ADC long call today, 60-20. Yeah, I mean, it's a good question, but realistically, that type of stuff happens in the market. Depending on what your exit conditions are and that kind of stuff. I mean, if you're always holding those trades until expiration, it's a lot less likely to happen. If you hold the trade through expiration and you're likely to see a more smooth result, between the 40, 30, 20 delta as you go further and further out of the money. If, however, you're exiting when you hit like a 40% return, well, that 20 delta could hit a 40% return very differently than a deeper in the money option. Like, take, for example, let's say that you buy something like 90 delta. So the stock's at 100, you buy like a 70 strike call. So that thing's deeply in the money. There's $30 of intrinsic value in it. If the stock goes up $2, that 90 delta option is going to go up about $1.80. So that thing's only going to show a 3, 4, 5, 6% return. The option that's a little bit out of the money, especially let's say you're 2 days away from expiration. 2 days away from expiration, if you're buying something that with at 100, say the stock's at $100, and you're buying the 103 strike option for a nickel that is 2 days from expiration, that thing could be very cheap. But the stock might go up $1 or $2. That might go from a nickel to being worth 50 cents. So that out of the money option could go 10x in value, because all of a sudden there's like a real chance this thing ends up in the money. Whereas something that had a lot more either premium or intrinsic value built into it isn't changing as a percentage as much. That in options that's called gamma. But yeah, sometimes out of the money options will move as a percentage a lot more than in the money options. And even if you hold it to expiration, there's still times, because if the at the money option is very expensive with premium, there are times that an out of the money option will do better than an at the money option, or even have a positive return when the at the money option doesn't. So I could go into more detail. It's all a little complicated, but in the real world that does happen. And I know it's a little counterintuitive, but that's definitely a possibility. Okay. Love that we're getting questions. We try to keep these to 45 minutes, but I'm gonna try to cut through a question or two more really quickly. I think I left off at Joseph. Every time we are required to sign in and accept the code and get access to the community, this is a bit annoying. Can I get rid of it once I've accepted the code once? Yeah. We do make people accept it every single time. It's kind of a philosophical thing. We just want people to be very mindful of the energy that they're bringing to community. We know it's a little bit annoying. We apologize. I think it's probably going to stay there for a while. So sorry for the annoyance. For the spread the sell-off trade, what is the profit target? Is it 80% of the initial credit received, or is it 80% of the amount risked? It would be, it's not, it's kind of the amount risked for an individual trade. Yeah, for spread the sell-off of the initial credit received. Yeah, that's a good question in terms of how that works. Essentially, it is 80% of the amount risked for that individual trade, not for the overall portfolio, but for that individual trade. Rama says, I am new. Where should I start? Yeah, so I would go to the Today tab. I'd look at some of the strategies that say beginner. I would click and watch a video. Once you feel comfortable, then I'd watch for one of those strategies hits. You can actually click on set Today tab alerts and say, if you know that you're interested to do buy the sell off, fade the dip, a couple of these strategies, you can just say, alert me when these things happen, save the alerts, and now you'll get an email when those strategies happen. Yeah, and then I would say, we can't make official recommendations, but I'd say just start small, track it, know when you're going to enter and exit the trade, look at the stops and limits and that kind of stuff in the trade. And then place a trade or two and watch it and see how it goes, or even place a couple paper trades and see how those look in your account. Once you feel comfortable, you understand what's going on, then you can kind of, do more of the same or add new strategies. Says, how do I create a backtest for short strangle 20 delta with closing at 50% profit? Okay. I want to be mindful of everyone's time here. So if you want to do a short strangle, go here and say short. If you say 50% profit, then you say gains 50%. And then you could customize your deltas here. So it's going to do, various things. So if you want to do a strangle with like a 30 delta call, 30 delta put, or something like that, then you could put that in there. You can also click portfolios, and you could backtest a whole, basket of these things. But if there's one stock that you want to trade, then you'd be looking at that at a trade like this, and then you could put, other technical conditions or other things that you wanted to put in there. Yeah, max answers are at the Learn tab. Yeah, actually, with respect to the previous, I think I answered a little too obliquely. It's the 80% of the initial credit. I think I said of the amount risk, but that's not accurate. I had to just give that a little thought. Kurt says using the standard plus or minus 40% default. Click on today's ADC trade for an example. Is it just the value of the option 15 minutes before the end of the day? Yes, it's the value at the end of the day. Yes. So it doesn't, when it comes to stops and limits, it doesn't factor in intraday movement for stops and limits. Yeah, so in theory, if the option goes way up during the day and then comes back down, you could miss it, or it could be the opposite where you end up saying, hey, when I hit a limit of 40%, I want to exit, but you might have a limit of 80% because it's always placing the trade at the end of the day. So yeah, that's correct. Jim says, so on some trades we are risking over 1,000 for 150 credit. So the losses could massively outweigh the winners. Well, if you have to look at individual trades, but yeah, if you're looking at because you might, when you look at risk as for the entire back test, if you start losing on the first few trades, your amount risked is going to be increasing. It then might turn around and have a $150 profit. So your amount risked will look huge and your amount gained will look small. But that could be a sign of a strategy that sort of recovered over time. Alternatively, if you're, selling a short put spread, I mean, that initial trade you might not want to put on as a 15-1, but if you sell a naked short put, then your theoretical risk is large. Probably shouldn't be. I mean, I guess that's about an 8-1 or 7-1 risk, but depending on the put spread, depending on the delta, it probably won't be quite that bad. But if you're looking at a strategy as a whole, it's probably because you had some losses along the way. It's not exactly your max drawdown, but essentially the individual trade you placed combined with your net cash position was pretty, you got pretty in the red at one point in the strategy, and then it finally pulled its way out. So that's probably why the amount risked looks pretty intense. Okay, great. We're just coming up on an hour. Paul, I think you had a question about risk on a strangle. So, go ahead and please send that in to support and flag me, and I'll make sure to have a look at that. And then I'll either get that answered or I'll bring it up in the next help session to kind of do a deep dive on it. Thanks everyone very much for being here. Thanks for being part of the community, and please, log on to the community and say hello. Yes, we apologize. You will have to click this thing saying that you're going to be nice, and come ask questions. Max is there. He's awesome. And the Learn tab has a lot of great resources, and we'll look forward to seeing you at the next one of these and at the next webinar in the future. All right. Thank you very much, everyone. Have a great evening.